In this video, you'll learn what cafeteria plans are, some options available in cafeteria plans, and the taxation of cafeteria plan benefits. Cafeteria plans, also known as flexible benefit plans, offer employees a menu of benefit options from which they can choose based on what best fits their and their family needs. Some benefits are core options that all employees receive, such as basic health insurance or life insurance. Beyond the core benefits, though, employees can choose additional options that best suit their personal circumstances. For example, they might opt for extra coverage or choose a childcare subsidy over additional insurance. Employees are often given a set amount of benefit credits or a budget that they can allocate towards the benefits they choose. This allows them to tailor their benefits package to their specific needs and preferences. Many cafeteria plans include benefits that can be offered on a pre-tax basis, such as flexible spending accounts, FSAs, for healthcare or dependent care expenses, which can provide tax savings for employees. The cafeteria plan is a separate written plan maintained by an employer for employees that must meet the specific requirements and regulations of Section 125 of the Internal Revenue Code. It provides participants an opportunity to receive certain benefits on a pre-tax basis. The employee can select from 2 or more offerings and tailor it to their specific needs. Let's talk first about medical benefits. There are several classes of medical benefits that qualify as Section 125 cafeteria plans. The most common of the cafeteria plans involves medical insurance for employees. Premium-only plans, or POPs, is a cafeteria plan type that allows employees to deduct premiums for the benefit on a pre-tax basis, reduces both the employees and the employer's FICA tax, and may include medical, dental, vision, and other plans. Flexible spending arrangements, or FSAs, is another type of cafeteria plan benefit that assists in the payment of medical expenses, childcare expenses, and prescription costs and transportation. IRS Publication 502 provides more examples. Employee contributions for healthcare are limited to $3,200 in 2024 and $3,300 in 2025. For dependent care, employees can set aside $5,000 annually for 2024 and 2025 pre-tax. This limit is reduced by half for employees with a tax status married filing separately. Contributions above these amounts are treated as taxable income. Typically, FSAs have a use it or lose it provision, meaning you must use the funds that were set aside as part of your payroll deductions by end of year. The IRS permits a rollover to the next year annually per employee at the employer's discretion. That limit is $640 for 2024 and $660 for 2025. So how does an FSA work? Before the year begins or when you start a new job, HR will ask you if you want to contribute to an FSA, and if so, how much. You decide on the amount, but it can't be more than the annual limit. Then, as part of each paycheck, you have a proportionate amount withheld. And when you pay for expenses that are reimbursable under the FSA, you submit a receipt to the FSA and get the money back. Many FSAs have a mobile phone app to make it convenient, and because the dollars were deducted pre-tax from your paycheck, you save tax money. However, you have to consider, are the tax savings worth the effort of having to monitor your spending and submit expense receipts to the FSA? Will you potentially forfeit some of the money that was withheld from your paycheck because your circumstances changed? Also, you may lose the FSA money unexpectedly. For instance, some FSAs have provisions that when your job has layoffs, you can only submit qualifying expenses up to the date of your layoff. An FSA is a good fringe benefit, but please read the fine print. Like, for instance, it is good to know that the employer owns the plan and the employer may retain unused balances in annual contributions. Health savings accounts are another type of offering in cafeteria plans. HSAs may only be offered by an employer if the health plan they offer their employees has a high deductible, as defined by the IRS. The minimum health plan deductibles in 2024 are $1,600 for employees only and $3,200 for the family. The out-of-pocket maximums for a high deductible plan are defined as $8,050 for an individual and $16,100 for a family. In 2025, to qualify as a high deductible health plan, the deductible must be $1,650 or more for an individual and $3,300 or more for a family. In 2025, the out-of-pocket maximum slightly increased from 2024. The health savings account functions like a bank account in that the employee owns the funds contributed, although employers may also contribute funds. Unused funds roll over each year and continue to grow with the account. Unused funds do not affect the yearly contribution limits. So let's look at the contribution limits. For 2024, they are $4,150 for a single individual and $8,300 for a married couple. And in addition, employees aged 55 and older may contribute an additional $1,000 per year as a catch-up contribution. Employer contributions to HSAs are tax exempt as far as federal income tax, FICA, and FUTA because sums contributed are not considered employee wages. The contribution limits have increased in 2025 by $150 for single individuals and $250 for married taxpayers. The catch-up contribution for taxpayers age 55 and older remains unchanged. HSAs differ from FSAs because the funds may be set aside for use later in life. Employees who are not offered an HSA by their employer may set one up with a trustee. HSAs are considered to have a triple tax benefit. Contributions up to the annual limit are tax deductible, any investment income is tax-free, and withdrawals are tax-free if there are for qualified medical expenses. Pre-tax versus post-tax deductions play an important role when deciding on fringe benefits. Let's take a closer look at what that exactly means. And here we have one example where the deduction is post-tax without a cafeteria plan, and the second calculation is where the deduction is withheld pre-tax with the cafeteria plan. The gross wages are the same, but the net pay is different. Both payroll calculations begin with the gross wages of $2,500. Deductions that are allowed to be pre-tax deducted reduce both income tax and FICA. Basically, the government is helping you pay for your benefits. In this case, the cafeteria plan and the pre-tax deductions resulted in tax savings of $86 per paycheck and annual savings, assuming a biweekly payroll of $2,236. As with all things taxes, there are some exceptions. Some pre-tax deductions, such as employees' portion of health insurance, is a pre-tax deduction for federal, state, and FICA taxes. Other pre-tax deductions, such as the 401k deduction, is only a pre-tax deduction for federal and state taxes, but not FICA taxes. For 2026 and beyond, the IRS continues to adjust contribution limits based on inflation, which is great for keeping up with rising costs. In 2026, both HSAs and FSAs for healthcare have slightly higher limits, and the same is expected for 2027. For the dependent care FSA limits, however, there is a very significant increase from $5,000 to $7,500 for employees who tax file merit filing jointly, and from $2,500 to $3,750 for those employees who file merit filing separately. In addition, the Secure 2.0 Act is influencing how benefits are designed, with a push toward automatic enrollment and more generous catch-up contributions. The push toward automatic enrollment of employees in benefit plans encourages employees to save for future retirement. However, it also highlights ethical consideration in terms of enrolling employees in plans they may not fully understand. Many employees don't check their 401k statements regularly and often don't move the balances after leaving employment with a company. Another development is that some states like California and New York are exploring state-run benefit plans, which could create additional layers of complexity. It's important for both employers and employees to stay informed about these developments because these changes impact payroll system setup and payroll processing.